Today we are joined by Mr. Stephen Bruce, the Portfolio Manager of the Perennial Value Shares Income Fund. Stephen, can you tell us a little bit about your background, Perennial Value, and your role within the company?
Sure. Perennial Value is a specialist Australian equities manager. The business was founded 16 years ago and currently manages around $8 billion in funds under management. That's across 4 strategies, being mainstream Australian equities, high yield equities or shares for income, Australian small caps, and risk management products. I've been with the business since inception 16 years ago. I'm currently a portfolio manager of the Shares for Income Trust and also co-manage part of the Mainstream Trust, and I'm also an analyst, having covered most sectors of the market over my time.
Stephen, why the focus on Australian shares as a source of income?
Over the long term, the Australian share market's been a great source of income for investors. The dividend yield on the market has averaged around 6% per annum over time, and in fact dividends have accounted for around half the total return of the market. But the real story is that the dividend income stream grows over time. In fact, it grows around 6% over the long term, and it's that growing income stream which helps protect investors against inflation.
Stephen, I'd like to spend a little bit of time now on the research process behind Perennial Value, with a particular reference to the Perennial Value Shares for Income Trust. Can you explain to us what are your investment objectives of the trust and what is the investable universe?
The investment objectives of the fund are to provide investors with a growing tax-effective income stream paid via quarterly distributions, and also to provide capital growth over the longer term. Our investable universe is Australian shares with a market cap down to $1 billion.
Your strategy centres around value. Can you explain to us the investment philosophy behind your process?
Perennial Value's investment philosophy is a moderate value style, and that means that we're essentially trying to buy good businesses with sustainable operations which are trading at a discount to overall market multiples. Now, these sort of businesses tend to re-rate towards market multiples over time, and that's the source of our added value. Some other important characteristics of our process are a focus on capital preservation, and by that we mean avoiding the big bad blow-ups, and you do this by having particular emphasis on financial strength and balance sheet analysis.
In terms of process, how do you select stocks for the portfolio?
The way we select stocks for the portfolio is we screen stocks on the basis of relative valuation. So we're looking for stocks which exhibit sustainable businesses trading at attractive valuations based on factors such as price to earnings, price to cash flow, price to book, and dividend yield. When we're constructing the portfolio, we construct it such that it overall has a higher dividend yield than the market. So we increase the weightings to those stocks which are exhibiting attractive value and have higher dividend yields. What's important when we put the portfolio together, though, is to maintain a high level of diversification, and over time the trust has had an average of 30 stocks over 8 sectors.
Is the major focus of the investment strategy on capital growth or income?
The primary focus of the investment strategy is generating a tax-effective growing income stream. So that's our number one priority. However, we also want to generate capital growth over time. So in a way, you can think of this fund as the reverse of our mainstream Australian equities portfolio, whose number one focus is on generating long-term capital growth, but also with an attractive income stream.
Stephen, dividend yield is highly concentrated in certain sectors within Australia, the banks being a classic example. Can you explain to us how you manage this risk?
There's a temptation when you're investing with a focus on yield to think, okay, I'll invest in the 4 banks, Telstra, maybe a toll road and an airport, and that's okay. But I think it's very important when you're investing with a focus on yield to maintain a high level of diversification, just the same as you would when you're investing with any other objective. And in fact, over time, we've found attractive yield opportunities in a large number of stocks across the majority of the sectors in the market.
Does the strategy use option strategies or hybrid securities to enhance income within the portfolio?
Our strategy typically doesn't use option strategies such as call writing to enhance income, and the reason for this is that we believe the underlying yield that we're able to achieve on the market is attractive in its own right. And further, if you're using those strategies, you tend to cap your upside by selling away some of that upside. So since inception of our trust, we've delivered gross income return of 7.5% per annum without employing options, and we think that that's attractive. In terms of hybrids, we typically don't invest in hybrids. The reason being that generally the yield on the underlying stock is more attractive than the hybrid. The stocks have upside in capital, whereas the hybrids don't. And we do believe that many hybrids have risks which aren't immediately apparent.
Are there any particular mandate rules within the strategy that provide protection to investors?
Yeah, we have quite strong portfolio construction rules to protect investors. For example, we can put no more than 10% of the portfolio into any single stock. Our firm cannot own more than 12.5% of any stock, and we have limits around how much we can allocate to each sector. And really that comes to our philosophy of not betting the house on any particular stock or thematic.
What are some of the key features of the fund?
The key features of the fund are that it's a diversified portfolio of financially sound, generally industrial stocks with a market capitalisation at the time of purchase of over $1 billion. We construct the portfolio to deliver an above-market dividend yield, and we pay income distributions quarterly. We also aim to generate capital growth over time.
What sort of investors does the fund suit, and what's the recommended time frame for investment?
The fund is ideally suited to an investor seeking a growing tax-effective income stream, but who also wants some capital growth over the longer term and is able to cope with some short-term market volatility. The typical investment time frame is 5 years plus.